Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend podcast. Tim is on assignment. Now, we've officially entered the final month of 2025. You know that. And all eyes are on this Wednesday's FOMC interest rate decision. That meeting with market participants, it is expected to bring another rate cut by the Fed, largely priced in, some say, despite the FOMC committee working with less economic data than usual after that government shutdown for more than a month. Now, for the latest on what to expect from the Fed meeting, head on over to Bloomberg.com or check it out on the Bloomberg terminal. Even without that data, we've got some really great reads this week into U.S. economic health. We have the CEO of Lending Club with an outlook on consumer credit. He joins us in just a moment. Plus, a deep dive into private credit with Christina Lee of Oaktree Capital Management, who also has a take on the health of the consumer that's actually impacting the firm's investment strategy. Also, why a recent downgrade in the cloud security company Zscaler is not phasing its CEO, Jay Chaudhry. We speak with him a little bit later on. All of that to come, but first, the online lending marketplace and platform for loans, credit cards, deposit accounts, insurance, and a lot more. We're talking about Lending Club. They announced recently a $100 million share buyback. It was just about 1 month ago, which was nearly 5% of the company's market value on the day of that announcement. Analysts have been raising their price targets on the stock this year, and even most recently, since the company reported earnings late October and posted third quarter results that beat estimates and provided a guidance range for new fourth quarter originations with a midpoint above estimates. We caught up with Scott Sanborn, Chief Executive Officer of Lending Club. He's been CEO for almost a decade, and he's been at Lending Club for 15 years now. Also joining our chat, Herman Chan. He is Bloomberg Intelligence Senior Analyst for U.S. regional banks, who helped bring this conversation, this roundtable, all together.
Scott, I want to start with you and just give us some size and scope of the business, the consumers that you're working with, who's interacting with the platform.
Yeah, so we serve a customer base we call the middle majority. They are, if you think about credit, which we are a credit-centric bank, if you've got a lot of money, you don't need a lot of access to credit. You pay cash for a car, you save up to send your kids to college. If you're on the other end of the spectrum, you can't really access credit. Mm-hmm. So there's this middle group that are high income, heavy users of credit. So they can afford a car, they can afford to send their kids to school, but they need to use credit to do it. That's who we serve. It's a really big customer base. It represents about a third of the U.S. population, but it's close to half of the credit wallet. So they are more likely than average to have every form of credit, and that credit is, with the exception of mortgages, also larger than average. That's who we serve.
How much do these people usually make?
Our average, and obviously misleading, averages can be misleading, but average is about $125,000. But you can think of it of ranging between, call it $80,000 in individual income to about $200,000 is where we really over-index.
Great. One of the real highlights of your recent Investor Day was the panel discussion with marketplace investors. And we talked about this earlier before your appearance here on radio. One of the panelists talked about aligning performance expectations, partnering with better operators. Are you seeing that with the private credit space?
Yeah, we do. So, we were born as a marketplace. Initially, everything we originated, we sold. When we acquired the bank in 21, we started to hold a portion of our loans on our balance sheet. That both gives us a stronger and more resilient earnings profile, also allows us to do other things, innovate using our balance sheet. And what we found is just by aligning our interest with our loan buyers, we're the largest eater of our own cooking. We're the largest holder of Lending Club loans. We care very deeply about the performance of the credit. And, credit is always evolving. It's very dynamic. Because we have a balance sheet, what we can do is when we want to test something new, we test it on our balance sheet. let's try longer duration. Let's try a larger loan size. Let's try a new marketing channel. We hold that first.
You own it.
We own it. We make sure it performs the way we expect, and then we release that to the marketplace. If you don't have a balance sheet, you can't really do that. And so that's visible in our results across every aspect of underwriting. So lower delinquencies than the rest of the industry, 30 or 40% below, lower roll rates, higher recovery rates, lower prepayments, lower fraud. Literally every aspect that you can measure of credit, we're outperforming on.
Has that remained consistent this year, in recent months, in recent weeks? Like, you have a great real-time view of the consumer in the form of how well they are doing in terms of paying back their loans.
That's right.
Still looking good?
Yeah, so that's been consistent for, we release 4 years of data we put out there, and so it's remained consistent, but, it's kind of like a duck on a pond. It's remained consistent because we're doing a lot of work underneath the cover. So, something that we shared at Investor Day is at any given time, we have more than 200 tests in the market where we're evaluating price points, changes to the credit. So we're constantly adjusting to reflect what's happening with the consumer. And that's what's giving us the consistent results.
Well, so that to me says you're very picky about who you lend to.
That's true. We are.
So in terms of your test, so tell me what it is. I mean, and how many of people who apply or want to access your platform, you're like, I'm out.
Yeah, so we're pretty good at selecting who we want to have in our portfolio and reaching out to those people.
Yeah.
And then both delivering the price and product experience, but also, let's call it the user experience that gets them all the way through. So we look for areas where, for example, we can control the use of the fund proceeds. If you come to me and say, I want $20,000 because I'm going to do whatever, my kid needs braces or I'm moving cross country, great. But unless I'm paying the orthodontist, I don't actually know that that's what you're using it for.
Yeah.
So we try to, set ourselves up so that we are in some ways controlling the use of proceeds and then making the experience such that it makes it really easy. So our largest use case is for people who already have debt, credit card debt, most notably, which at this point, more than half of all Americans are carrying. They're carrying it at really high rates, 23% interest rate. It's the highest they've ever been in history. And we say, great, you should do this instead. It takes less than 5 minutes. We're going to save you 700 basis points. Oh, and by the way, check all the credit cards that you have that you want us to pay off. Like we see you have Chase or a Cap One. Great, check those, and we're going to pay them directly. So we know you are paying off your credit card debt. You're not just saying you're going to pay off your credit card debt and taking out more money. We are paying it off for you. Benefit for you is, you've consolidated everything into one bill. Other benefit is your FICO score usually goes up by 30, 35 points because you've lowered, your utilization.
How much can you lower? Like, I got to tell you, credit card rates just blow my mind about how high they are. And I'm just curious, why are they so high? Are people so bad? Is it to cover? No, I'm curious.
Yeah, no, it's a great question.
I mean, it just seems like it's out of control. And I think it prevents people from becoming financially solvent or creating, kind of getting ahead of the game, if you will.
Yeah, there's a lot to unpack in that.
Sorry.
It is, no, it's a great question. And there's a number of questions underneath, but I'd say the biggest thing is, if you think about how people choose credit cards, it is not based on the interest rate.
Yeah.
Right? It's my Sky Miles card or my retail store card. I'm going to get rewards for this. They don't even know what the interest rate is, or it's a promotional rate that resets. So that's one. They don't choose based on that. Half of the people don't revolve on the card. They're collecting these rewards, but they're not carrying a balance. Well, guess who's paying for that? All the people that are carrying a balance. Those people don't know what their rates are. The research we've done is half of all customers don't know the interest rate on their credit cards, and the half that say they do, more than half of them are wrong. Right? Wow. They think they know their rate, but they don't.
Right.
And so cards have been able, and one of the big resets with the cards was driven by the Card Act, which limited how much cards could increase rates, so they factored in higher rates.
I just want to jump in real quick. We are speaking with Scott Sanborn, CEO of Lending Club. He's been CEO for close to a decade. We also have here with us Herman Chan. He's Bloomberg Intelligence Senior Analyst for U.S. Regional Banks.
Thanks. I wanted to follow up with you, Scott, on some of the medium-term expectations you laid out in Investor Day. You talked about doubling loan originations. We're talking about $18 to $20 billion a year. What are some of the levers to get you to that level? You mentioned use cases. Maybe talk about home improvement as a use case, and how do you maintain solid credit quality as you ramp up that
And
volume?
home improvement is something you're getting into, right?
That's right. Yep. First and foremost is, as I mentioned, credit card, refining people out of their credit card debt into a fixed rate, lower rate loan is number one use case. It's about 80% of what we do. That market is the largest it's ever been. There's 1.3 trillion in credit.
80% of what you do is that. Wow.
Yeah.
Go ahead. Sorry.
So that is, 1.3 trillion in balances priced at really, really high rates. We, when the rate environment shifted and the inflationary pressure shifted, we pulled back on a lot of our marketing. So we're currently running today at sort of below our historical volumes. So we're just going back into that market, turning back on marketing channels that we had turned off. And then the other area is, personal loans can be used literally for anything, right? And before credit cards came around and came to be, they were the dominant way consumers accessed, credit for everyday needs. So we have a major purchase finance business that's growing today, call it 50+% year on year, that's allowing things like elective medical procedures, LASIKs, braces for your kid, all kinds of procedure, fertility treatments, teeth implants. So things that insurance doesn't pay for, but you want to do and you want to do right away. Private school education, that's another one. So home improvement is sort of a next adjacency. People right now are staying in their homes longer. 75% of Americans, their mortgage rate is under 5%. They're not going anywhere.
Right.
And the homes are getting older. So the homes need to be invested in. They need to be improved. So effectively enabling home improvement through an unsecured loan where, again, we are controlling the use of proceeds. We can pay the supplier. We can pay the contractor. We've got the capability through an acquisition we announced to, disperse this in phases to multiple parties. So we're really excited to kick that off.
Consumer doing okay?
I'd say the consumer we serve is demonstrating themselves to be remarkably resilient. Despite,
I hear that a lot. It's a drinking game now.
But we'll acknowledge the sentiment isn't great.
Our thanks to Scott Sanborn, Chief Executive Officer of Lending Club, alongside our own Herman Chan. He is Bloomberg Intelligence Senior Analyst for U.S. regional banks. Coming up, the split mood around private credit, soaring inflows, rising risks, lots of questions.
One of the things to look out for is one of the questions I think that we all talk about are valuation marks, right? Is there transparency? Is there not transparency? I always tell people to ask them, what is your valuation methodology?
Christina Lee of Oaktree Capital Management joins us next. You're listening to Bloomberg Business Week. This is Bloomberg.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
In a recent opinion piece for Bloomberg, Apollo Global Management CEO Mark Rowan argued that much of the fear around private credit is based on myths, that the core of this market remains high quality and relatively safe. Even so, not everyone is so confident. Bloomberg opinion columnist Paul Davies argues that the lack of transparency in private credit is one reason that investors could be more fearful. He goes on to say that the outlook for repayment problems and bankruptcies isn't great, and that in fact, it's getting worse. Needless to say, a lot of questions have emerged in recent weeks about private credit. It all really goes back to that J.P. Morgan earnings call back in October, when the head of J.P. Morgan, Jamie Dimon, made that comment about more cockroaches being out there, kind of tapping into some of the concerns about the private lending world, the private credit world, the financial landscape, that there could be more problems out there.
Like, you should assume that whenever something happens, we scour all process, all procedures, all underwriting, all everything. And, we think we're okay in other stuff, but my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one.
This past week, we leaned on Christina Lee, Managing Director and Co-Portfolio Manager for Oaktree Capital Management's U.S. private debt strategy, for some insight.
Yeah, I think it's been called the Great Cockroach Wars, you name it. I think one of the issues that I think people are having is there's been some high-profile bankruptcies that have happened recently. And people are saying, is this systemic? Is this a pattern of what's next? I think sometimes you do have to take a step back and remember, we're doing sub-investment grade credit. You are taking risks. There will be defaults. There will be restructurings. You don't get 8 to 9% all-in yields by not taking risk.
Okay, so having said that, when you guys, especially, in terms of private credit, I think what really tripped a lot of investors or investments up in the private world, private credit, private equity for that matter, is that there weren't the exits that were normally there, right? We've seen them pushed off, and I think it's starting to come back. But then you had terms renegotiated. You just, all these things started to happen, and you just wonder whether it gets a little bit fuzzier and that there is more opportunities or more touch points for things to come undone. Roll that in and how we should be thinking about that part of it.
I think defaults have been very, very low in private credit. And if you were to look at various managers, their loss ratios, et cetera, default rates would probably all be relatively similar. Mm-hmm. And that's because private credit hasn't really been through a downturn yet, right? The advent of the class when it really started booming was maybe 10 years ago.
Right.
I think COVID was too short. I think what you're seeing right now also is defaults will likely rise because a lot of these borrowers put in capital structures when it was a zero interest rate environment, which is, now it's higher for longer. And I think that's why you're seeing defaults and some cracks emerge.
Does it get worse though? Because you're right. An investment in a zero rate where money costs nothing is very different from where we are today, right? It's just the business dynamics and the financial dynamics of a deal looks very different. So do we see more cracks going forward? Is Jamie Dimon right that there's never just one cockroach?
I think you likely will see some cracks, but what will be dependent is the cracks have been masked. The cracks have been around for a year or two. There's a lot of liquidity in private credit. And even in private equity, they weren't necessarily deploying in new investments, but they were helping their existing investments.
Forgive me but when does too much liquidity, though, become a problem where you're chasing after, there's so much more folks involved in the private market world, private credit, private equity. And when there's a lot of money around, it's like people are chasing deals and maybe more likely to take on even more risk. So when does it get messy, or does it not in this world? Maybe it's something different.
I think right now what you're seeing is there's still a supply-demand imbalance. As you had mentioned, there's less exits, there's less M&A, and so private credit dry powder has increased. But if we were to look at kind of the exit pace that private equity needs to do, M&A should increase starting in 2026, and that supply-demand imbalance should lessen. But right now what you're seeing is there's really an imbalance right now. And so you are seeing that competitive nature of private credit. And does that mean looser underwriting standards? A lot of time, yes.
We should note Howard Marks, the co-chairman, principal, co-founder of Oaktree Capital Management, out just last month. It was in the beginning of November with a traditionally long memo about private credit. But in bold on the second page, he writes, "So no, I don't think this is necessarily the beginning of a trend." And by the way, it's called Cockroaches in the Coal Mine. It's not an indictment of the whole sub-investment grade debt market or the whole private credit market. Rather, it's just a reminder that the yield spreads people care about so much are there for a reason, because sub-investment grade debt entails credit risk. You agree this is essentially just part of investing in this type of debt?
Exactly. If you don't take on risk, that usually means that you're yielding something lower.
Right.
It goes hand in hand. And I think because we've been in such a benign market where you haven't seen a lot of defaults, et cetera, that's why people, I think, are surprised.
So then what are the products, or what's the credit that investors should avoid right now? Like, how do you separate? Because another criticism, I guess you could say, is that there's not a lot of transparency necessarily with this type of investment. So then how do investors know what they should invest in and what they should stay away from?
Yeah, I think one of the things to look out for is one of the questions I think that we all talk about are valuation marks, right? Is there transparency? Is there not transparency? I always tell people to ask them, what is your valuation methodology? How often are you looking at your valuation? Because in the end, we are in a private illiquid market. there's no mark to market. There is no market. And so there is a subjectiveness and a judgment on the manager. And I think a lot of it is, do they mark their investments aggressively or are they conservative?
Right.
How do you know?
I think you have to ask your questions of what methodology do you use? Do you use discounted cash flow? How much does current yield matter?
But this is where, like, I think about, Christina, that a firm, whether it's Oaktree or somebody else, right? If you're playing games in terms of valuations or not being so transparent or whatever for your investors, the deals aren't going to pay off, right? And investors are not going to give you any more money. So is that kind of a checks and balance in some way in terms of ensuring you guys are doing the work, like they trust a manager?
Yeah.
And that you guys are making sure you have the transparency before you go into a deal.
Exactly, because if you are way too aggressive and all your marks are overinflated, you will have a really hard time with your investors.
Right.
Right? That is reputation risk. And also just inherently as a creditor, you are always worried about kind of what's next, what's the next risk, because your upside is getting what's contractually due to you.
Right.
So a lot of, just inherently as a credit investor, you tend to be conservative.
Because that's why some, and some of the conversations we've had in trying to figure out, like, are there more cockroaches out there? That maybe some of what some have said is smaller players that maybe don't do as much homework or something, that's where we might see some problems. Talk to us about the market overall, where you guys are finding opportunities right now and what kind of opportunities. And I'm curious if it tells you kind of what this investment environment, is it a healthy one? Is it a stressed one? Like, I'm just curious.
I would say right now there's a supply-demand imbalance. So what does that mean? It's very competitive. If you think about the first 9 months of the year with the tariffs, right? With all of the uncertainty, M&A went to a screeching halt for the most part. Now M&A has kind of come back after Labor Day. And so now you're seeing what I call a little bit of FOMO, where you're seeing a lot of lenders rush to get deals done. And I think this is the time that you want to be very selective. You want to be a credit picker because the terms are getting more aggressive. Leverage is going up, pricing is going down. And so from like Oaktree's philosophy standpoint is you really need to be selective. It's a yellow light. Proceed with caution. You're not going to stop investing, but you've got to pick and choose your spots.
Do you think this type of asset class will end up in the 401ks of many Americans?
I think that is, I call it the next frontier. I think from a technology standpoint, if you think about private credit, it's I'm talking about more sponsored direct lending. It's a pretty mature asset class at this point.
Right.
Right. And I think where you're going to see innovation was what I call technologies on reaching new investors or fund construction. And so I do think 401ks will be the next horizon, but that's also where private equity is also going into, right? And so will that help a little bit with the supply demand balance?
Yes,
probably.
Right.
Whether people want it or not in their 401ks, I don't know.
Well, it does, though. It creates another demand, right?
Yeah.
For what's going on there. Just got about a minute left. Can you share with us, I don't know, an interesting deal that you recently did? I don't know how specific you can get, but just give us an idea in terms of maybe the type of deal, terms, or whatever you can share.
Just not about a specific deal, but just what we're seeing in the market right now is it's counterintuitive, but as the interest rates go lower, you're seeing leverage creep up because borrowers can actually make their interest charges now. And so before, when interest rates were, say, 4% on SOFR, you didn't really see deals go over 6 times.
Yeah.
Because otherwise, a borrower couldn't pay their interest. Now it's actually going the other way, where you're getting lower yields but higher leverage. And that just notes the level of competition. So we're hoping that 2026 there will be a little bit more balance in deals.
Yeah.
But that's what we're seeing in the moment.
So does this assume, too, that you think the Fed will continue to cut rates even into 2026?
I think it all depends on who gets appointed.
You really?
What about Kevin Hassett?
So do you think is it a dumb thing that if it's Kevin Hassett that you can assume that there'll be lower rates? Just got about 30 seconds.
I'm not going to make an assumption around it, but we all have an understanding of what the administration wants is lower rates, right?
Interesting times,
and we'll see where the underlying economy also says, which hopefully will also dictate where the rates inevitably land.
Right, that the Fed sticks to the mandate and what needs to be done. Thank you so much. Really appreciate it. Christina Lee, Managing Director and Co-Portfolio Manager for U.S. Private Debt Strategy over at Oaktree Capital Management, joining us right here in our Bloomberg Interactive Broker Studio.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This past week, we got an update about the Trump administration ending a pay incentive program intended to hire and retain experts in the federal government's primary civilian cybersecurity agency, which has already been depleted by firings, resignations, and reassignments. Now, the program, known as the Cybersecurity Retention Incentive Program, will be eliminated in 2026 and replaced with a different incentive program called the Cybersecurity Talent Management System. Cybersecurity experts warn that ending the extra pay will lead to more departures at the agency, further weakening the federal government's defenses against cyber attacks, with some employees facing a significant pay cut of as much as 25%. That story on the Bloomberg. We know that cybersecurity experts have warned for years now that the rise of artificial intelligence and large language models will radically transform the way hackers operate and make devastating breaches easier to pull off, whether it's in the private or public sectors. Just last month, AI developer Anthropic said that it disrupted what it described as a highly sophisticated AI-led espionage campaign from China that used the company's Claude chatbot. Thwarting cyber risks of all kinds is the world of cloud security company Zscaler. The company released its operating results for its fiscal 2026 first quarter, which revealed accelerating revenue growth on the back of soaring demand for its products. However, the stock is still down roughly 30% from its 2021 record high when it reached what some analysts call an unsustainable valuation during a frenzy in the tech market. For more on the company, the outlook, and the world of cybersecurity, we caught up with Zscaler CEO Jay Chaudhry. Also joining our conversation, Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh.
We had an outstanding quarter. Our ARR growth, 26%, revenue growth, 26%, free cash flow margin, 52%, operating margin, 22%. We beat all the metrics that Wall Street was looking for. In fact, if you take our free cash flow margin and add it to our revenue growth, that's 78%. That beats the rule of 40 that many investors look for very, very well. And this is at scale of $3 billion or higher. There are only about 5 pure play enterprise SaaS companies that are in that unique class. So we've done extremely well. We are very proud of what we delivered, and we passed a meaningful beat we did and raised our annual target. So I think we're very pleased with it. I think investors get it wrong from time to time. This is one of those times.
That's what I was going to ask. You know, what you think investors just got it wrong? Because, I mean, 13% is a pretty big hit. So you think, I mean, that's not like them wavering at all. They really wanted more from you guys. I mean, the expectations were certainly high.
Look, markets do what they do. I have one focus: keep on innovating and serving our customers. And those innovations started with Zero Trust architecture, which has changed the world of old school firewalls and VPNs. And now as AI security is coming, AI security is becoming a big concern. And Zero Trust that we pioneered is the foundation of it. So we have amazing interest from our customers. That's why we're able to deliver these strong numbers. Over 45% Fortune 500 companies trust us, depend upon us. So I'm very bullish about our future.
So Jay, talking about AI security, I mean, you have a business model that's reliant on companies hiring more people, and you have a seat-based model. How does that change with AI security? Because AI, what we are seeing out there is more consumption-based. So how does that impact you and your business?
It's a good question. So we started out with bringing Zero Trust for users, so users can access applications without being on the company network. And natural pricing for that is user-based. Then we moved the model to our architecture, the next thing. How about Zero Trust communication for workloads, cloud workloads? That's actually based on number of workloads and actually amount of traffic. So it's not just user-based. If you think about AI security, there are many facets of AI security. But one of the biggest things our customers look for is, as every company starts using a lot of agents, these agents are somewhat like people. They need to access certain applications. They need to talk to other agents. So we are extending our Zero Trust Exchange that are designed for users and workloads and branches now to agentic exchange so that right agent can talk to right agent and right application. So obviously there's an opportunity for us to secure that communication. Yes, the number of users may not grow significantly, but I believe every company will have scores of agents for every single employee, and they need to be secured, and we are extremely well positioned to handle that.
And talking about agents, it sounds like one of your biggest competitors is doubling down on observability and identity, especially on the browser side, as an area of focus for agentic AI. Is that something you feel is very important to roll out agents?
So some companies try to go and buy many companies to create a collection of things. We are very focused on what we want. We were focused on zero trust, and then we focused on AI. Regarding observability, we actually do observability for the areas that matter to our customers. We sit between the user and the application. So today we have a sizable business, hundreds of millions of dollar business, with a product we call Zscaler Digital Experience, where we can tell our customers if any user is having any performance issues as they try to access those applications. It's integrated with the platform. While many companies have many point products and they are separate, we like to have integrated platform that serves our customers, so we not only provide secure and reliable experience, we make sure that it is fast and you can troubleshoot those things. But I'm not going into broad observability, which has become a broad area. We are focused on the areas that are relevant to our customers.
And identity, is that something you care about, the identity on the browser?
Identity is important. Think about identity for users. We have been working from day one with all leading ID providers for users, whether it's Microsoft and Okta and others. Now, when it comes to identity of agents, I believe there'll be many contenders. Microsoft, Google, AWS, Oktas of the world. Our philosophy is to federate those identity providers, use that identity, and we are the Zero Trust Exchange, the switchboard, to make sure the right AI agent talks to right agent. In this world, I do not need to own everything. I need to do some of the things I do the best and integrate with partners with proper API integration so our customers get the biggest benefit. We believe in doing a few things but do them extremely well and partner with others.
So I do feel like we're all learning as we go. And of course, Mandeep and Jay, you guys are ahead of us in a big way. But when they talk, Mandeep, about zero trust, this never trust, always verify, I think about digital touch points, thinking that there are threats within an organization and outside, and you've got to make sure there's security everywhere.
Yeah, no matter where you are, and that's where, SASE is a term that gets thrown a lot, and Zscaler is in the leading position in that Magic Quadrant. So I have one other question, Jay, for you. So given the amount of data in the world of security and, you guys generate trillions of data points, will the security world have its own LLM?
Yes, the answer is yes. We are actually working on building our security-focused LLM. And I do not need to have the large language model. Security is very focused set of high quality data. With over 8,000 customers and 45% of Fortune 500 companies, we generate over 500 billion transaction logs a day. Those logs are anonymized, but they can give us an idea of where the threats are coming from. We can find a needle in a haystack and help all of our customers. So AI is only as good as the data that powers it, and we have the best data, and we believe we can help identify some of these threats in almost near real time and provide a closed loop system so that the threats can't really exploit our customers and provide them benefit at a much faster ways. That's why we are focused on AI-powered security operations. And our acquisition of Red Canary is part of that strategy because they built some very, very good agentic AI technology that we're integrating with our platform.
The use of AI to make the system more robust certainly makes sense, but the concern about how AI has made the attackers just more robust and the attacks more robust. Can you point to specific instances where hackers have actually used AI to enhance their attacks, and did it work?
Yes, there are many, many examples. Let me give you a few simple ones. Every attack starts by finding your attack surface, where you are. And public IP address is the starting point. Every firewall, every VPN, every application portal is an attack surface. In the past, a hacker may have taken weeks to identify it. Now you can go to ChatGPT and say, tell me all the firewalls and VPNs that have vulnerabilities, and give it to me in a nice tabular format. Under 60 seconds, you can get that. Now, the second part hackers would do is these phishing emails. Now they can ask AI to say, write an email that looks like a CFO's writing style, no typos, make it very targeted. That's number two. Third, hackers are using automation that AI provides. Once they are on the network, automation can find the key applications and try to encrypt that data. A lot of that is happening. What does Zscaler do in this case? Number one, we hide your attack surface. Your applications are hidden behind our cloud. Bad guys can't even find you. They can't find you, they can attack you. And the second is own the network. The biggest problem with firewalls and VPNs is they're trying to protect the castle, and we actually make it zero trust.
Jay, we've got to run. This was so informative and so enlightening in terms of AI security. We so appreciate it. Jay Chaudhry, he's founder, chairman, CEO of Zscaler, and of course our own Mandeep Singh of BI.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Plenty ahead in our second hour of the weekend edition of Bloomberg Business Week. We have a great glimpse of the world around us from real estate to retail, including, it's shopping's biggest season, so what does Target need to do to turn its business around? Plus, break out the hot chocolate. We catch up with the founder and global CEO of the UK-based chocolatier, Hotel Chocolat, this company taking on the U.S. First up this hour, a lot happening with New York real estate this past week. New York Mets owner Steve Cohen won approval to operate a casino next to Citi Field in Queens as one of 3 projects selected for gambling licenses right here in New York City. 2 other projects were also selected. Genting Group's Resorts World, which proposes to expand a casino next to the Aqueduct Racetrack in Queens, and Bally's Corp, which plans to operate a gaming facility at the site of a Bronx golf course. We spoke with Ron Eliasaf. He is founder and managing director of Northwind Group. It's a real estate private equity firm in Manhattan that has transacted over $5.6 billion of debt and equity investments in residential, commercial, senior living, and healthcare properties.
It was a long wait, I think, for a lot of the observers and the companies who put in bids for these licenses. I'm just wondering how you view this in terms of changing the real estate landscape. This one is not in Midtown, where one of the other licenses could have gone. But how do you view it?
I think in general, it's a positive thing for New York City. I think it was given it's not going to be in Manhattan. And I think to support growth in communities in Queens and Bronx, it's overall a positive thing. It will create jobs, opportunities, increase tourism and attraction. I think the Hard Rock bid together with Stevie Cohen is going to make great things for Citi Field there. It's great transportation. I don't think anybody wants a casino in Times Square or anywhere in the city.
Agreed.
The thing that's
and
puzzling...
overall, it's going to be, if you look at the 3 projects that are almost there, right? They're still final stage to get done. It's going to be total over $20 billion invested in developing the real estate around it, hotels, tourist attractions, concert venues, music. It's a good thing.
On the casino side, though, the thing that's puzzling to me is that we all have casinos in our pockets with our phones nowadays, it seems like. And the rise of prediction markets, the rise of online sports betting and doing it through apps, it means like...
It's not the same experience, though, Tim.
You don't have to go to Vegas or Atlantic City.
Sure.
I don't gamble personally,
either.
but I think casinos are not what you do on your phone. It's exactly what Carol is saying. It's a touristic attraction. You go there for the experience. It's coupled with great dining, with shows, Cirque du Soleil or whatever it is. And I think it will overall increase tourism to New York.
Interesting. Take a big picture right now. How do you see real estate in New York right now?
I think right now everybody's bracing for the Mamdani taking office in January and what will come next. I think there's been positive signs. Tish staying on as a commissioner seems something that, at least for the real estate community, is perceived as a positive thing. I think public safety is on top of everybody's mind. But with that said, there are some pretty aggressive legislation looming. Recently, City Council is pushing COPA, Community Offer to Purchase. It's not sponsored by Mamdani per se, but it's definitely something that you see as a left-wing agenda. It basically means that anybody that owns a multifamily building will have to first give a right of first offer to nonprofits and community organizations to purchase. It basically could potentially stall selling real estate, multifamily.
Those multifamily buildings aren't moving anyway, though, right?
They are. They're moving.
Are they?
I'm not rent-stabilized buildings.
Okay.
This will, if it passes, they got a pretty overwhelming initial vote.
So this goes for rent stabilized and non-rent stabilized too? So any multifamily?
Any multifamily.
Oh, wow.
Above certain unit count, which is pretty overwhelming. Again, it hasn't passed yet, but this sort of agenda will scare investors potentially and will make people pause. The city, you asked about the city. In general, the city is facing a supply shortage that's unbelievable.
But what would this do for a supply shortage, though?
This will hurt it. Because you will think twice before buying.
I think that's what's so puzzling to us, and I'm going to speak for Carol a little bit, because we talk about the supply-demand challenge with multifamily real estate and with real estate in New York City anyway. The prices won't come down unless you build more housing.
This sort of legislation will do the exact opposite.
And I'm not taking a political position here. I mean, this is
not a political position. This is supply
demand.
Supply demand in economics. If the city council or the mayor wants to reduce pricing, what they have to do is push more supply in. You push more supply by providing subsidies, by endorsing legislation that makes it easier to build,
changing zoning,
less effective, increase upzone, not limiting someone's ability to sell their own property, rent their own property. So this will have a negative effect, not a positive effect.
I mean, what are the rules? I mean, I don't understand why when a developer is building a building that there isn't either a certain percentage that's always put aside for people who maybe don't make as much money.
Well, there have been certain programs, right?
Certain programs, but why? I mean,
I've seen the full affordable kind of subsidies have been tapped out. They've maximized in the budget. So then there was 421A that tapered off and died. Then 485X. Those have built-in 20-25% affordable components in it.
For every new construction?
Yes, if you qualify, right? And then now with... what
do you mean if you qualify?
There's certain ground... Well, 421A is expired, but 485X, you have to qualify with pricing and how much you do. But then if you build ground up and you've done it in the time frame that the legislation existed, you would have to build 25% or provide 25% affordable.
So why do you think? Is it just zoning that we don't have enough affordable housing here in New York City?
I mean...
Or any major city?
The issue in the city is the land is limited.
Yeah.
Right? Manhattan is an island.
Right.
Cost of land is very high. Cost of construction is very high. It's not like building somewhere in the middle of Texas. You can just bring your trucks in. You have to stop traffic. You have to build. The cost of labor is more expensive. So everything costs more to build. So the end product costs more. So for you as a developer, it has to be more profitable to justify it.
Right.
But the city has done a few things right. If you look at City of Yes, it was a great program. It is still a great program. The 467M tax abatement, which basically said if you convert an office building to resi and set aside affordable, you get a tax incentive, property tax incentive. Those have been positive, I think, examples of how the city has done it right.
Yeah.
This specific bill on the table is a very bad example, and I hope it doesn't pass.
I think people could also point to something closer to my neighborhood, like Gowanus rezoning. I mean, if you go to along 4th Avenue in Brooklyn and you know the Gowanus area that was rezoned, there's just huge buildings and thousands of units that are going up there as a result
Tim,
of
I completely
rezoning.
agree with you. Upzoning is the right way to go because in the long term, the city will benefit from more property tax eventually on more units being built. I would personally upzone the entire Midtown district that connects to Hudson Yards. Right now, you have these mid-block garment district
What is
buildings.
upzoning?
Giving more property rights.
Oh,
right? You have
okay.
a building right now, you can build 12 times more than what your land lot size is.
Yeah.
Double it.
Yeah,
I mean,
yeah.
it's not like
So
we're
you can go
building.
higher, essentially?
You go higher.
Yeah.
Go higher. I mean, the city, we have plenty of sky rises here, right?
Yeah.
High rises.
Yeah.
I think one of the challenges would be transportation to move all the additional people. And I think about that a lot.
Dense.
It does get dense. And it's not like you can't add more cars to the subway. You can't always increase frequency of subway trains coming because some of these trains share tracks.
It has to come with
what's the right
investment
way to
in
do it?
infrastructure. So this is upzoning is not something you press a button. You have to plan
Right.
10 years ahead, and it has to come with additional infrastructure for public transportation for sure. So in places in Queens and Midtown, you have to plan and building more public transportation. I think eventually you're going to see also these driverless cars coming in. That will have a huge impact on traffic over time.
Wait, in a positive way?
I think in a positive way, definitely.
When do you think they'll arrive? We've
I've seen
anyone
them
who
driving
knows-
around the city.
I'm so in love.
I've tried it in the West Coast in LA. It was
It's
one
great.
of the best
Right?
experiences.
I've never met anyone who tried it and didn't like it.
It's like unbelievable. The rate environment. If indeed it's expected that the Fed's going to cut rates next week when it meets, how is that impacting kind of deals, valuations, opportunities right now?
It's pretty. I think it's pretty priced in right now. I think if you look at if you look at the forward curve, it's pricing in this reduction. It expects it. I think we're very close to being in kind of a neutral state. I don't think we're going to see another significant decrease in rate. Maybe another 50 bips over the next year, but not more than that. That's what the market is pricing, and you're seeing more liquidity flow into the real estate market in general, both from the lending side, from the credit. We've seen spreads come in and more loans available, and equities back, and people are making investments. They feel more comfortable now that there's more predictability.
Our thanks to Ron Eliasaf. He is founder and managing director of Northwind Group. You're listening to Bloomberg Business Week. Coming up, off of the back of retail earnings and Black Friday, we take a deep dive into Target and the uphill climb for its incoming CEO. And speaking of earnings, Macy's reported this past week, posting better than expected results. But the retailer warned that it may be seeing softer demand to come in the future. For details, our Romaine Bostic caught up with the CEO of Macy's, Tony Spring, for a pen and pad interview and joined Bloomberg's Danny Berger and Matt Miller to talk about it.
I mean, I did ask him a lot about what foot traffic was. Was there an actual increase? He did say he was happy with foot traffic, but he also seemed to imply here that a lot of the revenue gains that they've seen in this most recent quarter was people buying more. So basically bigger tickets, bigger receipts, if you will, rather than actually more people going in there. But this is also a company that is, he's doing the conference call now, and he's been asked a lot about how strong this holiday season is going to be. And one of the reasons why you see the shares down a little bit here is the comp sales growth, while certainly an improvement over previous years, is still kind of lagging what you would have seen at a company like Macy's in holiday seasons of past. Remember, this is going to be, or supposed to be, their best quarter of the year, their fiscal fourth quarter.
Going to a physical store seems like a quaint idea, but a strange thing to do, right? I mean, most of us buy all of our stuff online. How are they doing with that?
Well, I mean, first of all, the average age of a Macy's shopper is over 40. It's like, late 40s, I think is the average age. So that gives you a sense of one of the challenge that they're going. I know, Matt, and you're still in your 30s. But it gets to this idea here that there is still a cohort of boomers out there that do want that physical experience. Macy's obviously is now trying to make sure that their younger generation of Gen Z and beyond, that they are actually engaged in the physical stores and trying to make them more experiential. That's the long-term story. And that's what he's doing. He's basically taking 350 Macy's stores, basically going to revamp all of these stores to make them more experiential. He's only done about 125, 150 so far. They're going to get to the rest over the next year and a half, 2 years.
It feels like we're in this bizarre world where the retailers who do well, it's because you've got like Sydney Sweeney to do your campaign, or Cat's Eye, or some sort of celebrity. I mean, Macy's isn't doing that, but it feels like we're in this weird era of collabs and influencers.
Well, it's interesting. And you bring up, obviously what we're seeing with American Eagle. Their shares on fire. I think when when they open. They're going to be having their best day in a couple of months. But it gets to this idea, that's a singular brand, right? And Macy's is a multi-brand retailer in an era where a lot of us go directly to the brands themselves. We connect with those brands either because, Matt salivates over Sydney Sweeney in that ad or something else. And the question is, how does Macy's sort of, get that fire? They've had a lot of collabs with Wicked and other things like that do get people into the stores, but it's a much bigger challenge, Danny.
That's Bloomberg's Romaine Bostick, Danny Berger, and Matt Miller. Just ahead on Bloomberg Business Week, more in the retail space and a look inside the inner workings of Target. I'm Carol Massar, and this is Bloomberg.
This is the Bloomberg Business Week Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Target has had a tough couple of years. Well, its almost 2,000 stores still sell a ton of stuff, and the company remains profitable. Some observers say it has long had a culture of high self-regard, which can be dangerous in an industry as rapidly evolving as retail.
Yeah, sometimes you got to be humble. The ailing retailer has
lost, yeah. I made a typo, I'm sorry. That was my fault.
Has lost its cheap chic appeal. Can a new CEO get it back on feet with his old boss next door? I always think about that when there's a new CEO and yet the old CEO is kind of, somewhere as executive chair or something. That's the question, though, at the heart of Jaewon Kang and Devin Leonard's profile for Bloomberg Business Week. You can check out the story. It's on the terminal and also at Bloomberg.com. Devin joining us right here in our Bloomberg studio. God, Devin, by the way, senior global business writer. Just want to get your title out there. Hey, Target is a retailer we all know and have probably loved at different times. I have been one of those people when they did those fashion combinations, and I wanted to be there.
I thought you were going to say the tea kettle.
No, not the tea kettle, but
that's a big star of the profile.
But I've lined up, because I wanted to, get a piece of some fashion folk, and their combination or their collaboration with Target. Talk to us about how you wanted to approach this one, because they've been going through a tough time for a while here.
I don't know. I mean, it's just this company that at its, in its good times, people have just really loved it, been really passionate about it. And my wife, my daughter were really into it. My daughter, as a teenager, spent just hanging out there. And that was her whole thing. They'd be selling, Anna Sue, handbags, but at a price that, my daughter, who's 16, could afford. And so this whole thing of kind of like bringing design, bringing fashion to the masses, to teenagers, it's this huge achievement. And yet, things have been really tough, and sales have been declining. They peaked, during the pandemic, and they just haven't been able to get their group back. And there have been a lot of missteps, but we wanted to sort of delve into that and look at that and go talk to them about that. And so we did in early September, and spent a lot of time researching, going back to them. But I mean, no, it's kind of a tragic story at this point. I mean, maybe they can turn it around, but they're in rough shape.
Well, you got to attend this pep rally for that was kind of the culmination of the most recent CEO's time at Target, Brian Cornell, and you spent some time with him and his successor.
Soon to be successor. Incoming, right? Pending, right.
I was looking for the word incoming.
No, I know it's confusing.
How does he look at his time and sort of the arc of this narrative? Because there's a little bit of a disconnect.
Yeah, no, totally, Tim. Because I mean, that was the thing. It was this huge, event, 14,000, upper level, Target employees in this, 8 o'clock in the morning in the Target Center. The music's booming, red lights everywhere, and then, Brian Cornell, the current CEO, has been CEO since 2014, comes out, and basically it's going to be his last time as at Target together as CEO. And, it's a big look back at, at the highlights, and basically emphasizing that when he came in, he did a really good job. And, the company did turning around then. He did that. He pulled it out of Canada where they were losing money. He rebooted a bunch of stores and rebooted a lot of the store brands. the company peaked though, in 2022. And he didn't really talk about what happened after that, except we didn't really grow. And there's all kinds of things that happened in the last couple of years that contributed to, the decline of their stock and the decline of their sales. They've had some big political controversies. They ticked off conservatives. They ticked off, liberals with their abandonment of DEI. So sort of they're kind of like a all purposes offender. And then their stores have been operated. Their stores have been kind of a mess. Anyway, he sort of ignores all that. And then he bursts into tears on the stage, and it's kind of like, well, wait a minute. He's announced that he's stepping down. He's not leaving, though, until January. And then his replacement and his right-hand man, who's an insider. That's not to say that, maybe he won't. That's not to say he won't work out. But it's not what investors wanted. The stock dropped, and it was this moment, kind of like, he was kind of milking this moment on stage in front of all these folks when his last couple of years have been kind of a disaster. If he'd left in 2022, he could have gone out in history as a great retail CEO, but he stuck around and.
They waived the mandatory retirement age for him a couple of times, right?
Well, once was enough, Carol. I think, but
was it once?
Yeah, well, still.
But I think what's fascinating, and you see this over and over again with companies, and they're, in a hard place, trying to figure out their way forward. And then they just tap somebody who's been at the company for another 20, who's been there for 20 years. And I know sometimes folks are like, well, it's good you have an insider who knows it, but a lot of times what you need is an outsider.
Well, actually, and we're neglecting something here, because it's one thing to basically ignore investors and appoint consummate insiders. Some guy's been there for 22 years, but we're neglecting to mention that on top of that, Brian Cornell, the guy who a lot of people think is responsible for, who presided over, the sort of catastrophe over the last couple of years, he's not going anywhere. He's sticking around as executive chairman. And I think there are instances where, like Jeff Bezos, when it's time to, they name, his replacement, Andrew Jassy. I mean, he sticks around as executive chairman. It's kind of like, well, he's the founder. He's responsible for a lot of the company's success. Yeah. If he wants to stick around and kind of keep an eye on things and lead the strategy, fine. But when you're somebody who's had a really terrible record in the last couple of years, why are you sticking around? And why is the board
allowing it?
Yeah. He's the chairman of the board, but it just seems to speak to kind of a larger problem at Target. That the thing you mentioned at the beginning about a lack of urgency in addressing problems, and sometimes even acknowledging they have problems.
Mm-hmm. Right.
So when Cornell came in a little more than a decade ago. Right. He pulled the plug on the Canada stores, which was seen as a pretty big move.
They were all losing money.
They were all losing money.
Yeah, 133 of them.
But they hadn't been in Canada for that long.
Right.
And there were just a lot of, as you point out in the piece, a lot of execution issues.
Right, exactly. Supply chain issues.
Yeah. Right. At what point, like the Target that you describe and that Carol describes, and the taking out all the ad, like the takeover the New Yorker.
All that stuff is, and I remember also.
What was sort of the end of that? Like, why did that era decline?
Well, all of that stuff happened. Certainly for the most part, happened under this CEO Bob Ulrich, who became CEO of Target in 1987. They just had about 300 plus stores. Mm-hmm. It was part of Dayton Hudson, sort of a department store company. But he basically decided that to compete with Walmart, we have to have like kind of cooler style our products. We have to have cleaner, more well lit stores. The execution has to be better. But he kicked off this whole thing that sort of, I won't say it culminated, but it really started, with the Michael Graves partnership, and that was in 1999. That resulted in the famous tea kettle, which of course we can't stop talking about. You can mention enough times in the story because it's just sort of like, it was incredible. It was a piece of art that people could buy for $34.99. But in any case, he steps down because of the retirement age limit in 2008. He's replaced by Greg Steinhoffel, who was his number two, his right-hand man, and that just didn't really work out. Even Bob Ulrich says in the story he thinks that's the biggest mistake he ever made, but they never probably the worst decision in my Yes.
Blank. God blank life is what he said.
Yeah. Fill in the right. But
Steinhoffel did not respond to requests for comment.
But so Brian Cornell comes in 2014 and after Steinhoff was ousted. And by the way, that follows the the hack in Target in 2013 that was. And the funny thing is, like, that's something that's happened in a lot of companies since, but at the time it was kind of a first and it blew everybody's minds, and he took responsibility for it and kind of lost his job. But so Brian Cornell came in and fixed a lot of that stuff. But I think in terms of like maintaining that that stylistic edge, the edge on design, I think that kind of started to wane, and then in the pandemic, they themselves admit that they weren't really staying in touch with the consumer. People were working from home and they weren't doing all the things they do. Was going out to consumers' homes and like looking through their makeup bags and all that stuff. They're kind of trying to do that now and trying to make up for that. But they really lost the edge. But so to answer your question though, it's happened slowly. And then, in the pandemic, post-pandemic, it sort of accelerated, really rapidly, the sort of decline.
I mean, I have to say, when my daughter was younger, I lived in Target. Like, I was there all the time. And sometimes I've gone back for her, even today, and she's not a little one anymore. Right. But so what do folks say needs to be done at Target? Because I got to say, when it was in its groove, it was a pretty cool retail place.
I know. They're really successful.
Super successful. And everybody talked about Target, right? It was kind of cool. So what do outsiders or folks say needs to be done?
Well, they need to get their edge back in style and design. They say they're doing it at that. I mean, of course, the question is, they really got there in the first place in a very different kind of, media, retail environment. So it's a bit of a challenge to recreate the success that they had. I mean, you can't just like I guess you could take over the New Yorker now. I don't think it would be quite the same thing. But they have that. They still have operational problems at their stores. I mean, you can go to really nice stores in the suburbs. We went to a very nice one in Edina, Minnesota, right outside of Target, where it turns out quite a few of the top Target executives, including one Michael Fidelke, shop. So of course that place was fantastic. But or you can go to the Target down the street from where I live in Washington Heights on 121st Street.
Is everything locked up?
Yeah, and it's a mess. So how do you really? And I think there's kind of in between sort of my Target and the Target we went to, but they have to fix all that stuff. They have a bunch of unhappy employees. They have to do something there, but a lot of it is just executing at the level that they used to execute, and then they've kind of let that slide. And can they do it in 2025, 2026? It's a different world than it was in the aughts. So we'll see.
Well, it's a cool deep dive. Another one. You always do these stories where you're just kind of like into so much detail. You learn a lot. Devin, thank you. Really appreciate it. Devin Leonard, he's Senior Global Business Writer at Bloomberg Businessweek. Check out his story. Jaewon King and Devin Leonard doing it for Bloomberg Businessweek. Yeah, no. What a good reporter.
Yeah, very, very, always awesome, both Devin, when you join us.
Thanks.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
You know what I love about the holidays?
Is it chocolate?
Yeah, basically.
I knew you were going to say that.
Cut to the chase.
Well, it's funny that you say that. It's funny that you say, because our Bloomberg News team is out with the ultimate foodie gifts for anyone who likes to cook and eat. Did you see this? Hit the terminal?
No, nice job.
The word chocolate, it's mentioned 10 times in the gift guide.
Say no more.
Okay, it's all for good reason, because it's the time of year where we like to indulge, and that often includes, at least for me, and I know for Carol Massar, eating our share of chocolate.
Has to be really good chocolate.
With us here in the Bloomberg Interactive Broker studio is Angus Thirlwell. He's founder and global CEO of Hotel Chocolat. It's the UK-based chocolatier that has more than 150 cafes in the UK. You'll remember, this was bought by Mars for more than $660 million. That deal closed at the beginning of 2024. So it's been almost 2 years since you've been under the Mars umbrella. Almost 2 years.
Yeah, and we've been really busy since then. Thank you. The whole rationale of combining with Mars was to strap rocket launchers onto the Hotel Chocolat brand. We already knew from previous entrees into the American market that the brand resonated with people. The playfulness and the contemporary design, coupled with a really strong approach on more cocoa, less sugar.
Yeah.
So even with milk chocolate and white chocolate, dialing up the cocoa so it's not overloaded with too much sugar. So
we care.
You're speaking my language right now. Like more cocoa, less sugar.
Yeah, totally.
Yeah.
Like I'm talking like 95% dark is like,
Well, yeah. You're almost at my level. Yeah. That's
What's your level?
100%.
I love that. Okay.
Yeah, I take it as a drink every morning. We have a drinking chocolate machine called a Velvetizer, which enables families at home to make barista grade drinking chocolate really effortlessly.
A velvetier?
A Velvetizer.
Oh, Velvetizer.
What is drinking chocolate comprised of?
Well, if we step back and consider the history of humans and cocoa together, the history in the drinkable version is 5,000 years, according to the latest archaeological digs where they found ceramic fragments of drinking goblets with little traces of cocoa on. And the edible version is only just over 200 years of history. Oh. So the drinkable version has way more heritage. And basically what you do is you take the cocoa bean and grind it up and then dissolve it into either a water base, which is the early civilization's way, or the way we prefer in a Velvetizer, put it onto your preferred milk, either dairy or plant, and it makes the most amazing, rich, deep, wholesome chocolate drink.
And this is sugar-free?
You can go sugar-free, so you don't need to add any sugar.
Yeah.
It's either already in there to a very restrained level, or, as I'm hoping to get you on, we can take you all the way to 100%.
All right.
Not a single scintilla of sugar there.
Angus, let's do it. I'm ready.
But it's fascinating that you say that, because I think the views around chocolate, certainly maybe globally, but I know certainly in the United States, has changed in terms of looking at the amount of cocoa or chocolate that's in something, and that I think Americans are changing their preference. Tell us about the American market and what your experience has been since you guys have been moving into it.
Yeah, so we're based in Chicago now, and we've spent pretty much all of 2025 trying to win over the city of Chicago by opening 5 amazing locations and taking really careful note of the way people are interacting with our chocolate. And what we're seeing is that our neon sign that's in every store that says more cocoa, less sugar.
Yeah.
People are doing Instagram pics against it, and they're really loving that. The drinking chocolate, which we serve, over-indexes as a mix compared to our UK model. So that's telling us that the American consumer is very open to experimenting with, if you like, composed and original drinks, and you don't have to go far.
We love our drinks.
I know if you look at the New York culture, the LA culture, the drinks are an art form.
Is it hot, cold, both? Like
both of those plus ice.
Ice, okay.
Yeah, and we also have a version where we combine it with our own soft serve as well, if you want to go, all the way. So we really noticed those dimensions, and we've also noticed that the preference for amongst affluent Americans is dark, and they start off saying, I'm a dark person, don't even show me any milk. But there's a way to do milk chocolate well, which is, it can be very creamy and still loaded up with loads of cocoa. And so that's been a bit of an eye-opener, we think, for the Chicagoans to taste really high-end milk.
You mentioned the idea with the Mars partnership and Mars acquiring you a couple of years ago was to strap this rocket ship on expansion. Certainly the idea of distribution is incredibly helpful with a global company such as Mars, but also about sourcing and getting the actual ingredients. Are you able to get ingredients, the same ingredients you were getting as an independent company, now for cheaper as a result of being part of Mars?
Yeah, in some cases, yeah. I mean, if we put cocoa to one side, where we willingly spend more than the market price, and I'll come on to that if you'll permit me a bit later. But when we're looking at other things like hazelnuts, we're able to use the buying power of the group and the financial strength of Mars as well. I mean, as an independent business, we could offer a certain security over our trading relationship with our favorite hazelnut supplier.
Yeah.
But when we're part of Mars, suddenly our credit rating is much higher, and that can get reflected in better terms. It's how the world goes around. So yes, there are some of the synergies, but the combination was more about growth, not really about a cost-based play. Yes, we'll collect those along the way to try and be a more efficient business and reinvest the proceeds into more development and more growth.
I'm still obsessed with the Velvetizer. I'm just going to say.
Now I know what I'm getting you
it
for Christmas.
Exactly. So talk to us about the U.S. market, the growth that you've seen, and tell us what it's like. So you mentioned Chicago. Tell us about expansion and what you've seen since you've been here.
Yeah. Well, I mean, if we look at our domestic market first, which is the UK market, there's loads of headroom left there. And we've opened about 25 locations in the UK over the last 12 months.
Yeah.
And here in the US, we very much a standing start, but already 5 open, and they're spread across different neighborhoods in Chicago and also on a Magnificent Mile as well. So we're going into the holiday season all guns blazing, with an amazing offer.
What is the growth market for you guys? Do you see the United States as being like a bigger and bigger part of the business?
Yes, very much. I mean, the US is the world's biggest consumer market, as we know. It's the leading media and culture center for the world. I mean,
social media plays a role in, right? Like expanding the brand.
Hugely, yeah. I mean, it's the way we built it in the UK was word of mouth. We didn't spend any money on above the line advertising.
It's amazing.
It was all PR and word of mouth and reviews. And we very much want to focus on similar tactics in America. We know we've got a story to tell. We know we're differentiated. And America is our total focus for growth. We know that if we win in America, we can then win everywhere, as Frank Sinatra said, almost.
Well, so what's the expansion plan in New York and Los Angeles and other parts of the country?
Yes, you won't be surprised that we've scoped out already, the next 3 to 5 years, and we're clearly looking at New York and California and the other kind of interesting states. So, I mean, there's a wealth of headroom available for us to grow into. But the key thing I bring is an insistence on quality growth.
Right.
We're not just trying to rack up, like numbers of stores. The most important thing is to hold on to that quality, the way our team interact. They need training. They need to know everything about cocoa and chocolate, and that gives the confidence to be able to engage and have a proper conversation. And our supply chain, which Mars will help on hugely, the logistics, the things like filing patents, getting permits, which are different state by state. So all those things are pretty, difficult for Brits to understand, where it's one homogenous country. It's like one set of planning laws.
Right.
But in America, it's such a vast market that you've got to crack the code for, California when you've just learned it for Illinois.
Yeah. Some people live in New Jersey and work in New York and have to pay taxes in both places.
It's not fun. You do get some of it back
Okay.
A little bit later on.
Yeah.
Just final thoughts in terms of where you hope this business is, I don't know, 2 years? What's a fair timeline that you're thinking about? And got about a minute left here.
I think, in the UK, it took us 10 years to become a household name brand. In America, we're hoping to do it in half the time.
That's no pressure.
Well, come back, please.
Just going to say, I'm a person who leaves my office, and I'm going to just tell you there's another chocolate place that's down below, but I will actually buy chocolate on my way home. So Hopefully you guys will be in the neighborhood soon so I can do that.
It's our full intention. Yeah.
Angus, thank you so much. Happy holidays.
Thank you.
And thanks for coming in. Angus Thirlwell, he's founder and global CEO at Hotel Chocolat, joining us right here in studio.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.